If you've started a new job recently, there's a decent chance you've been placed on something called emergency tax, and most people don't realize it's happened until they notice their pay looks a bit lower than expected. It's not a punishment and it's not permanent, but it is worth understanding, because it can quietly cost you money until it's fixed. Here's the short answer. Emergency tax is a temporary tax code your employer applies when they don't yet have enough information to work out your correct one. Instead of using your usual tax-free allowance, the system often taxes you as though you have little or none, which usually means you pay more tax than you actually owe for a while. Emergency tax codes usually get applied for one of a few reasons. Maybe you started a new job and didn't have a P45 from your last one. Maybe it's your very first job, so there's no tax history for HMRC to go on yet. Or maybe something's changed, like a company benefit, and your code hasn't caught up yet. On your payslip, emergency tax codes usually look like one of these. You might see 1257L, followed by W1, or M1. These mean your tax is being worked out fresh each pay period, rather than looking at your whole year so far. Or you might simply see BR, which we covered briefly in video 1, that means no tax-free allowance is being applied at all. Here's the part that trips people up. Normally, PAYE looks at your total pay and tax so far in the year, and adjusts accordingly. W1 and M1 codes ignore that. They calculate tax fresh, based only on that single payslip, as if it were the only one you'd ever have. This often results in overpaying, especially if your pay varies. Because emergency tax codes often ignore your tax-free personal allowance, or reset your tax calculation every payday, you frequently end up paying more tax than you actually owe. It's not lost money forever. It's usually refunded eventually, but it can mean a noticeably smaller payslip for weeks or sometimes months until it's corrected. Say someone starts a new job on emergency tax with a BR code. Instead of their usual tax-free allowance being applied, every pound is taxed from the start. That can mean a noticeably smaller payslip than expected, sometimes a difference of over £100 until HMRC receives the right information and corrects it. The good news is, emergency tax almost always sorts itself out. Once HMRC has the information it needs, usually from your employer submitting details, or a P45 catching up, your tax code updates automatically, and any tax you've overpaid gets refunded through your pay, or as a separate refund. So here's what to actually do. First, check your tax code on your payslip. Look for W1, M1, or BR. Second, if you haven't already, make sure your new employer has your P45 from your previous job, or fills in a starter checklist if you don't have one. Third, if a few pay periods pass and your code still hasn't updated, you can check or query it directly through the HMRC app or your personal tax account. If you've been on emergency tax, there's a good chance you're owed money back. Next, we'll cover exactly how to claim a tax refund from HMRC, including how far back you can go.